Jonathan Gardner, he's Chief Asia and Emerging Market Strategist at Morgan Stanley. Starting off, of course, with the Fed, but Jonathan, we would want a lot more. But let's start off with the risks of the Fed governor sounding hawkish when he sketches out his view today on the policy. And how high do you think is the possibility that he may be more hawkish than what the street is estimating, Jonathan?
Well, I think what's really interesting is that the private markets, the LIBOR markets, dollar LIBOR, has already moved far more aggressively than Fed funds. So if you look at 6-month dollar LIBOR, it's actually reached 2 3/8, whereas the Fed is likely to raise Fed funds by 1/4 of a point to 175. So we've actually already, for the interest rate that really determines corporate costs, are experiencing a very significant increase in interest rates. So unless the Fed is in some ways sort of super dovish, I think we're already looking at a significant tightening of monetary policy in the US. And in addition, China is tightening monetary policy at the same time. And this joint tightening is a key reason why we're so cautious on markets here.
So, Jonathan, could there be 3 hikes, or will they give any kind of indications that there could be a 4th one as well? Is it too soon to do that? And are the markets already pricing that in?
It'll be 3 or 4, but as I tried to indicate, that it's not actually really the Fed that's in the driving seat in relation to corporate cost of funding. The dollar LIBOR markets, which is actually where corporates borrow at, have already moved to 2 3/8% for 6-month money. And that's, again, a key reason why I think markets have struggled, because the acceleration in the tightening up of private markets, dollar LIBOR markets, is the story of the year, not the Fed.
If that's the case, Jonathan, what's your forecast for the global equities in that context?
Well, our thesis for the year was a rougher ride, and we had a number of things we're concerned about. The reduction in the Fed's balance sheet and actually the fiscal easing in the US is probably one of the reasons why money markets are getting so tight, private money markets. There's some evidence that the Treasury bill issuance by the US government is actually crowding out private borrowers to some extent. And at the same time, we have exceptionally high valuations for the non-financials part of global equities, and overly optimistic earnings expectations in my coverage, certainly in Japan and in North Asia in particular. So this sets us up for a market which we are pretty sure reached its highs for the year in the euphoria of the 3rd week of January. And the rest of the year is quite simply going to be a tough market. And so we're now 2 months since the market's peaked. And I think that thesis, which was very counter consensus in January, is becoming more well understood in the marketplace now.
Okay. Jonathan, last week, data suggests that global investors put in the highest amount into global equities in a long time, nearly 43 billion, which was pulled out from the money markets. So that seems to suggest that in certain pockets of the market, there is a risk on. And here you're sounding very, very bearish.
Yeah, so global equities are experiencing fund inflows, but they've been somewhat choppy. And in my area of expertise, Asia and EM equities, we actually saw in the 3rd week of January an all-time high dollar inflow week, about $8 billion. You're referring to the total universe of flows, which was skewed towards US markets. When you see euphoric fund inflows, it's typically characteristic of a market top. Retail investors are allocating money to the market, but each institutional investors, our evidence is, are reducing risk in equities and moving particularly into shorter dated bonds. So I think that, again, the flattening of the yield curve, the fact that the dollar LIBOR rates are going up, but 3 to 5 year maturity yields have stopped going up, is really kind of indicative of just how near to the end of the cycle that we're getting. So I would put the retail investor inflows into the bucket of something to be concerned about. If you go back, for example, to early 2016, there were very large retail investor outflows, and that's typically characteristic of a market trough, and was on that occasion.
Jonathan, what about the commodity and the currency story? And will the supposed bottoming out of the dollar prove to be a cap on commodity prices, particularly crude?
Yeah, we don't think the dollar is going to be as weak this year as last year. And against some EM currencies, and that does include the Indian rupee, we would expect their parities actually to weaken up somewhat against the dollar going forward. It comes back again to what I started the interview in talking to you about, the fact that dollar LIBOR markets have moved up a lot. So you're getting a much higher interest rate if you lend into dollar markets than you were this time a year ago, and that interest rate's increasing on a daily basis right now. So, you know, the competition in relation to relative money market rates is certainly picking up, and that should stabilize the dollar.
Okay, what about, okay, fine, so that's the currency bit. What about commodities? Do you think crude has hit areas wherein we could say that it's a near-term top for that? And what about the other commodities as well?
We're more bullish on crude than we are on metals and mining. So we think the Brent price averages $75 a barrel this year, and it's a story of relatively tight global supply in our view, and actually continued strength in demand in both China and India. And that, I think, keeps the market relatively tight. Whereas in the case of the slowdown we're seeing in Chinese property, we would expect things like iron ore to soften. Indeed, iron ore has been quite weak over the last few days.
Jonathan, can't not have a conversation about India. What's your view on emerging markets in general, in India in particular? And is the spate of good news which buoyed investor sentiment in India coming to a bit of an end?
So we entitled our mid-November year ahead piece A Rougher Ride, so I think our view was perfectly clear then. What then happened was markets moved beyond our base case targets, overshot them significantly in January. They've now come back in some cases pretty well at our targets. You look at Hang Seng on the MSCI IM index, we're almost at our year-end targets. But I do think near term, particularly with the trade protectionism agenda coming out of the US, there's a possibility that we undershoot to the downside. And obviously these are continually under review. But what I would say is that I don't see any particularly good news on the horizon at the moment for markets. Now for India, we were very overweight India last year, but we've been reducing our overweight. We've done it twice, and we've got a very small overweight left on India right now. And I think what, again, one has to be cognizant of in relation to India is the backup in government bond yields in India, which threatens to withdraw some of the flows we've been seeing from on the domestic mutual fund side. But the good news about India is that its growth trajectory is much less trade dependent than other major EM. Its growth trajectory has actually finally picked up. So that is the good news story about India.
Okay, Jonathan, we'll leave it at that. Many thanks for joining us today and giving us that perspective.